Welcome to the debate. How does a company that makes barely $83 million a year in profit from its actual software business end up sitting on a treasury worth, over $60 billion?
It's a pretty wild ratio, honestly.
Right, it is. So today we are examining this totally unprecedented financial architecture over at MicroStrategy. Originally they were a traditional enterprise software firm, but under Michael Saylor's direction, the company has transformed into the world's largest public holder of Bitcoin, hoarding over 840,000 coins by May 2026.
Yeah, which is just a staggering amount of capital.
Exactly. And this isn't just a pivot. It's a fundamental redesign of what a publicly traded company can even be. I'm going to argue that MicroStrategy has successfully engineered a completely novel financial institution, basically a digital credit bank that safely leverages the explosive growth of Bitcoin, all while protecting itself against the forced selling that usually destroys highly leveraged funds.
Well, look, I look at the exact same balance sheet, and I see a massive systemic risk. Like, this isn't a bank. It is a massively over-leveraged hedge fund, basically parading around in a corporate wrapper.
You really think it's just a hedge fund?
I do. Because by issuing billions in high-yield debt to continuously purchase a wildly volatile asset, they've built this mathematical trap. The entire structure totally depends on Bitcoin keeping up a hyper-growth trajectory forever. And if that growth ever just slows down to a normal pace, the math of their debt is going to trigger a catastrophic unwinding.
Okay, so let's lay out the architecture of what they've actually built, because you really have to look past that legacy software business to understand their new reality. They are pioneering what they call a three-layer digital credit model.
Right, the three layers.
Yeah, and to break it down simply, layer one is the bedrock. That's the actual Bitcoin sitting safely on their balance sheet. Then layer two is the credit layer. So instead of just holding the Bitcoin passively in a vault, they issue sophisticated financial products to investors.
Like the preferred stock.
Exactly, like their STRC preferred stock, which pays a pretty high 11.5% yield to investors. These layer two products basically act as a bridge between traditional Wall Street money and the Bitcoin network. And then layer three is the application phase, where this credit is integrated into the broader financial system. It's an actively managed financial platform, not just a simple speculative bet.
Calling it a highly engineered platform really glosses over the brutal reality of their cash flow. The foundational problem here is the sheer disproportion between their actual business operations and their speculative holdings.
But that disproportion is by design.
Maybe, but let's look at the numbers from this recent quarter. Their software business made about $83.4 million in gross profit, right? But their Bitcoin holdings are worth north of $60 billion. The software business is effectively a rounding error at this point.
Sure, it's small compared to the Treasury.
Right, so they are an entity that borrows real dollars at high interest rates to buy a digital asset that produces zero cash flow. Bitcoin doesn't pay a dividend. So when you have an asset that doesn't generate income, how do you pay the massive interest on the debt you took out to buy it?
Well, they have mechanisms.
But fundamentally, you have to either sell the asset or you have to constantly borrow more money from new investors just to pay off the old ones.
See, you're completely ignoring the mechanics of their specific debt structure. They aren't taking out traditional bank loans where, a missed monthly payment triggers immediate default. When we talk about their convertible bonds, we are talking about unsecured debt.
Unsecured doesn't mean free, though.
No, but it changes the risk.
They still owe the principal. And on products like their preferred equity, they owe that staggering 11.5% dividend. This is exactly where the Peter Schiff critique lands perfectly. Schiff argues that this structure functionally mimics a Ponzi scheme.
Wow, a Ponzi scheme. That's a heavy word.
It is, but look at the actual mechanics. MicroStrategy issues new shares of STRC preferred stock to bring in fresh cash from new investors. They then use a portion of that new cash to pay the 11.5% dividend to the older investors, and they use the rest to buy more Bitcoin.
Right, but
if a business cannot cover its bills from its own operational revenue and has to constantly sell new paper to pay off the old paper, that is a deeply flawed, unsustainable model.
okay. Using the term Ponzi scheme here fundamentally mischaracterizes basic corporate finance.
I mean, let's apply Schiff's logic to a traditional bank.
A bank is different. They have actual loans.
Hear me out. A bank takes in new deposits from new customers, right? And it uses those deposits to fund new loans and pay yields to the older depositors. No one calls JPMorgan a Ponzi scheme. We just call it financial intermediation. MicroStrategy is acting as that bridge.
But banks have cash flow from the loans they make.
Yes, but the reason MicroStrategy works without relying purely on new money is the mathematical reality of their asset base. Michael Saylor has openly explained the compounding math here. Because their underlying pool of Bitcoin is so incredibly massive, 840,000 coins, the absolute dollar growth of that asset easily eclipses their debt obligations.
I want to stop you right there, because that argument requires a massive leap of faith.
How so?
The math only works if the asset actually goes up.
Well, let me finish the calculation because it proves the sustainability. They owe an 11.5% yield on a relatively small slice of preferred stock. But if the price of their entire $60 billion Bitcoin treasury rises by just 2.3% in a year, the absolute dollar value of that tiny 2.3% gain completely covers all the dividend payments.
Assuming it goes up.
Right, but they don't need explosive triple-digit growth to stay solvent. Because the asset base is so large and the amount of debt is relatively low, a tiny, boring percentage increase in Bitcoin's price generates billions in real value. That keeps the balance sheet overwhelmingly positive.
Okay, but that 2.3% safety net only exists on a spreadsheet assuming smooth linear growth. We are talking about Bitcoin here. Smooth linear growth does not exist in crypto.
It is volatile, yes.
Very volatile. Let's talk about what actually happened between October 2025 and early 2026. Bitcoin didn't grow by 2.3%. It plummeted from $126,000 down to the mid-60,000s. That is a 47% collapse in a matter of months.
And they survived it perfectly fine.
But during those down months, the dividend doesn't pause. They still owe 11.5% to those shareholders. Because of the new accounting rules, which require companies to mark their crypto assets to current market prices, MicroStrategy had to report a catastrophic $12.4 billion net loss for a single quarter.
On paper?
On paper, sure, but you cannot claim an asset naturally outgrows its debt when it routinely loses half its value overnight.
See, the volatility is exactly why the architecture of their debt is the true stroke of genius here. In traditional finance, if you buy an asset with borrowed money and the asset drops 47%, the lender issues a margin call.
Right. Forced selling.
Exactly. They force you to sell your collateral at the absolute bottom of the market to repay the loan. That forced selling is the mechanism that wiped out companies like Celsius and Three Arrows Capital during previous crypto winters. But MicroStrategy has completely neutralized this risk. They flat out refuse to use their Bitcoin as direct collateral for these loans.
By issuing unsecured debt instead.
Precisely. By issuing unsecured convertible notes, the lenders have a claim on the company as a whole, but they do not have a specific lien on the Bitcoin. It's not like a mortgage where the bank can just take the house. If Bitcoin drops to $20,000 tomorrow, no bank algorithm can automatically seize MicroStrategy's treasury and dump it on the market.
So they just wait it out.
Exactly. They have built a fortress that can withstand unbelievable volatility. They simply wait out the winter. The debt doesn't mature for years, giving the asset plenty of time to recover.
Okay, they might not face a mechanical margin call from a bank, but they absolutely face a structural margin call from the broader stock market. You're isolating the debt from the stock, but they're intrinsically linked.
How are they linked in a way that forces them to sell, though?
Because MicroStrategy's entire machine runs on a feedback loop fueled by the premium of their stock. Investors historically pay a massive premium over the actual value of the Bitcoin to own MicroStrategy shares.
Right, the NAV premium.
Right. When the stock is flying high, Saylor can issue new shares, buy more Bitcoin, the Bitcoin price rises, the stock rises further, and the loop continues. But what happens when that 47% crash hits? The premium evaporates.
Monumental. I mean, they are sitting on over $50 billion in equity against roughly 10 to 15% leverage.
But the mechanism of survival breaks down. If the stock price collapses alongside Bitcoin, they can no longer issue new shares to raise capital without aggressively diluting their existing shareholders into oblivion. And this is exactly why the external market categorizes them as a systemic risk.
You're talking about the Wall Street critiques.
Exactly. Which brings us to the critique from heavyweights like Jamie Dimon and the analysts at JPMorgan. The danger isn't just their internal debt math. It's how the global financial plumbing treats them.
The JPMorgan critique essentially accuses MicroStrategy of not being a real operating company. They basically attempted to label them as a passive exchange-traded fund or an ETF.
And that label almost destroyed them earlier this year. We really need to explain why MSCI, the index provider, considering kicking MicroStrategy out of their global indices, was a near fatal event.
It was definitely a tense moment for the stock.
Very. For anyone who doesn't track passive investing, trillions of dollars in the stock market are controlled by index funds. These funds do not make active decisions. They are essentially algorithms that follow a strict list provided by companies like MSCI.
Right.
So if MSCI says a stock is a real operating business, the algorithms automatically buy it. But if MSCI categorizes a company as a passive holding fund, meaning its only real purpose is to just sit on an asset, the rules dictate it must be removed from the main indices.
Which would trigger forced selling by those passive funds.
Exactly. JPMorgan analysts sounded the alarm that if MSCI kicked MicroStrategy out, it would trigger automatic, indiscriminate selling of up to $8.8 billion of MicroStrategy stock by index funds.
That is a massive number.
It is. It wouldn't matter if Saylor's internal math was sound. $8 billion of forced selling would crush the stock price, entirely destroy the premium they rely on to issue new debt, and lock them in the exact death spiral we've been talking about. They wouldn't be able to pay the STRC dividends without liquidating the very Bitcoin you claim is safe in their vault.
Okay, the threat was real, I'll give you that, but you're ignoring the outcome of that exact crisis. MSCI investigated the structure, and in January 2026, they officially decided to keep MicroStrategy in the index.
Barely.
But they scrutinized the JPMorgan critique, and they rejected it. And the reason they rejected it goes back to the three-layer digital credit model I outlined at the beginning. MicroStrategy is fundamentally not a passive ETF, and the broader market agreed.
Keeping them in the index doesn't validate the business model, though. It just means they squeezed past the specific regulatory definition.
No, it validates their core operational premise. Compare MicroStrategy to a real estate investment trust, a REIT. A REIT is an entity that exists almost entirely to hold massive portfolios of real estate. Or look at a major oil exploration company.
Oil is very different.
Well, their primary valuation is based on billions of barrels of crude oil sitting unextracted in the ground. Nobody calls an oil company a passive ETF just because its value is tied to an underlying commodity. MicroStrategy actively manages its treasury.
But they don't.
They don't just put Bitcoin on a hard drive and go to sleep. They are continuously structuring complex credit products, managing bond maturities, issuing preferred equity, and running their enterprise software business alongside it. They are operating a highly sophisticated treasury business.
There is a massive structural difference between an oil company and MicroStrategy, though. An oil company actively drills, refines, transports, and sells a physical commodity that the global economy actually consumes daily to function.
True.
They generate massive operational cash flow from that activity. A REIT collects monthly rent from thousands of tenants, generating the cash needed to pay its debts. MicroStrategy produces absolutely zero yield from its Bitcoin. They are borrowing money at high interest rates to hold an asset that pays them nothing to hold it.
But the asset appreciates, which means the only possible way this entire machine survives, the only way they pay the debt, avoid dilution, and keep the Wall Street indices happy is if the price of Bitcoin constantly goes up.
Look, every investment relies on an assumption of growth. If you don't believe in the long-term appreciation of Bitcoin, you obviously shouldn't invest in a company whose entire treasury is based on a Bitcoin standard.
Right. But to claim they are on a razor's edge ignores the massive buffer they've secured. Across their 840,000 Bitcoin, their average purchase price is roughly $75,540. Even with the wild volatility of early 2026, they possess billions of dollars in unrealized gains.
Unrealized gains do not pay 11.5% dividends. Cash pays dividends.
And they have options to generate that cash efficiently without disrupting their core position. Because they acquired these coins over many years at wildly different price points, some as low as $10,000, others near $125,000, they hold a strategic tax advantage.
You mean tax loss harvesting?
Exactly. If they absolutely needed operational cash, they could strategically sell specific high-cost basis Bitcoins. This would generate the necessary liquidity while actually providing a tax benefit on paper. The Treasury management is incredibly deliberate. It's built to withstand a decade of sideways price action if necessary.
Sideways price action is exactly what kills them, though. You keep talking about how they can survive an 80% crash, but a crash isn't the biggest threat to MicroStrategy. The biggest threat is maturity.
Explain the distinction you're drawing there.
Okay, so the entire Saylor model assumes Bitcoin will forever behave like an explosive early-stage technology asset. When an asset is small, it can easily double or triple in a year. But as an asset scales into a multi-trillion-dollar market cap, the law of large numbers takes over.
It gets harder to move the price.
Exactly. It requires exponentially more global capital to move the needle. If Bitcoin matures into a standard global reserve asset, which is exactly what Saylor claims he wants, its yearly growth rate will naturally decelerate.
It stabilizes.
Right, it stabilizes. What happens if Bitcoin's growth rate settles into a normal, boring return of, say, 5 or 6% a year? Traditional investors would be perfectly happy with a safe 6% return, but MicroStrategy would be mathematically doomed.
Because of the debt.
Yes, they are locked into paying 11.5% on their preferred stock and high single digits on their other debt structures. If the asset they hold only grows by 6%, but the debt they owe grows by 11%, the company bleeds to death slowly. The safety buffer of unrealized gains just slowly evaporates to cover the spread. They are making a massive, leveraged gamble, not just that Bitcoin will go up, but that it will go up violently and continuously.
But that argument assumes they will never refinance their debt or restructure their credit offerings as the asset matures.
You think they can just easily refinance?
Absolutely. The 11.5% yield was necessary to attract capital during a specific early phase of their growth. As Bitcoin becomes less volatile and more universally accepted as institutional collateral, MicroStrategy's cost of capital will plummet.
That's a big assumption.
It's just market mechanics. They will be able to issue new debt at 3% or 4% to pay off the 11.5% debt. It's exactly like a homeowner refinancing a mortgage when interest rates drop. They're currently pioneering the space, which requires paying a premium. But as this digital credit layer becomes normalized, their position as the first and largest institutional holder gives them unparalleled leverage to dictate the terms of their own financing.
Well, refinancing only works if the market still views you as a premium credit risk. If the asset is moving sideways and your cash flow is bleeding, institutional lenders aren't going to offer you a cheaper rate. They're going to demand a higher risk premium.
I don't think they'd be bleeding, though.
We saw exactly how quickly sentiment can turn during that $12.4 billion loss quarter. The market is fickle. If Wall Street decides the MicroStrategy experiment has stalled, the ability to effortlessly refinance just vanishes. You're treating future optimal market conditions as a guarantee.
No, I'm treating the underlying architecture as sound. By eliminating the threat of direct collateral margin calls, Saylor has removed the exact mechanism that causes immediate, fatal financial contagion. He has bought the company the ultimate luxury in finance: time.
Time to hope the price goes up.
Time to wait out the market. Even if the growth slows or the market enters a multi-year winter, the debt structures are built to outlast the drawdown. They've essentially engineered a financial shock absorber massive enough to handle the crypto market's inherent earthquakes.
A shock absorber doesn't generate forward momentum, though.
So how would you summarize the skeptical position based on everything we've looked at today?
Simply put, regardless of the sophisticated terminology, calling it a digital credit system or unsecured convertible debt, MicroStrategy basically operates as a highly leveraged fund totally reliant on hypergrowth.
Right.
Their legacy software business is completely overshadowed by their debt obligations. The math of their survival requires Bitcoin to outpace their massive dividends and interest payments. So if the cryptocurrency market matures and just cools down to traditional growth rates, this brilliantly engineered debt structure becomes an inescapable trap.
Fair enough. And my summary is that MicroStrategy has successfully executed the most ambitious corporate transformation in modern history.
By using Bitcoin as an unencumbered base layer and systematically avoiding the direct collateral loans that destroy lesser companies, they have created a brand new type of digital bank.
A bank without cash flow?
A bank that utilizes the natural compounding math of a massive, appreciating asset base to comfortably service its debt. And they do all this while offering traditional market investors a regulated, yield-bearing bridge into the Bitcoin ecosystem. It is a calculated, sustainable fortress.
But looking at all the evidence and all the structural debates, there is one absolute undeniable point of convergence between both of our perspectives here.
Which is?
Everything, the MSCI index inclusion, the ability to pay the 11.5% dividend, the stock premium, the refinancing strategy. Literally every piece of this machine requires Bitcoin's price to continue appreciating over the long term.
On that, we are in complete agreement. The incredibly complex financial engineering is ultimately a multiplier on a single underlying thesis. If the foundational asset fails to grow, the structure cannot survive.
It forces us to ask entirely new questions about the nature of corporate valuation. I mean, we aren't just looking at quarterly earnings anymore. We are watching a live stress test of whether a company can entirely divorce its value from its operational cash flow and tether its existence to a decentralized digital commodity.
Which makes this one of the most fascinating case studies in the history of capital markets. For anyone listening, delving into the actual mechanics of their convertible bond offerings and the STRC preferred stock reveals just how deeply engineered this strategy is. It challenges our fundamental definitions of what constitutes an operating business versus a financial fund.
I highly encourage listeners to look directly at the quarterly reports and the math behind the yield requirements. The numbers tell a story that goes far beyond the headlines. You have to decide for yourself whether the math represents an impenetrable financial fortress or a mechanism slowly tightening its own constraints.
MicroStrategy has built the largest, most audacious financial tower the market has ever seen directly on top of the most volatile asset class in the world. They are confident their shock absorbers are flawlessly engineered. Whether those mechanisms hold up to the next major tremor, well, the global market will eventually reveal. Thank you for joining us on The Debate.